The method of Richard Wyckoff stands as one of the most enduring and effective approaches to analyzing market cycles, empowering traders to anticipate future price movements with remarkable clarity. His profound insights into market dynamics and principles of trading are widely regarded as some of the most potent and time-tested strategies available to serious market participants. This comprehensive guide aims to unlock the full potential of Wyckoff's laws, providing a practical framework for identifying highly profitable trading opportunities and significantly maximizing returns. At its core, successful trading with Wyckoff revolves around understanding the intricate logic and strategic actions of smart money, the institutional investors and large professional traders who ultimately drive market trends. By deciphering their footprints, individual traders can align themselves with the powerful currents of the market rather than being swept away by them. The journey to mastering Wyckoff begins with a deep appreciation for his three fundamental laws, which form the bedrock of profitable trading decisions. These principles offer a lens through which to view market behavior, transforming seemingly random price fluctuations into logical expressions of underlying forces. Grasping these laws is not merely about memorizing definitions. It is about cultivating an intuitive understanding of how supply, demand, cause, and effect continually shape the financial landscape. They provide the essential conceptual tools needed to interpret chart patterns and volume data, allowing traders to make informed choices that are grounded in market reality. Without a solid foundation in these laws, the more advanced concepts of Wyckoff's phases and events would lack their full analytical power and practical utility. The first cornerstone is the law of supply and demand, a universal principle that dictates price action across all markets. Its essence is straightforward. Prices will invariably rise when demand for an asset surpasses its available supply, reflecting a greater willingness of buyers to acquire shares than sellers to part with them. Conversely, prices will fall when supply overwhelms demand, indicating an abundance of sellers eager to liquidate their positions relative to buyers. When demand and supply achieve a state of relative equilibrium, prices tend to consolidate or move sideways, indicating a period of indecision or balance between market participants. This fundamental interplay is the primary engine behind every single price movement observed on a chart, from the smallest tick to the most significant trend. For practical application and maximizing profit, traders must analyze trading volumes in conjunction with price movements to discern the true balance of supply and demand. A rising price accompanied by increasing volume strongly signals that demand is dominant, confirming the strength of an uptrend and suggesting further upward movement is likely. Conversely, a falling price on expanding volume indicates that supply is in control, validating a downtrend and implying continued downward pressure. If prices rise on low volume, it may suggest that the upward movement lacks genuine buying conviction and could be easily reversed. This discrepancy provides a crucial early warning signal for potential trend weakness. By meticulously observing these volume-price relationships, traders gain invaluable insights into the underlying market dynamics, enabling them to anticipate the direction of the next significant price swing and identify optimal entry and exit points. This analysis helps to filter out false breakouts and confirm genuine market conviction. The second fundamental principle is the law of cause and effect, which posits that every significant market movement, or effect, is preceded by a specific period of preparation, the cause. This cause manifests as either a phase of accumulation or a phase of distribution. Accumulation is the strategic buying by smart money, building up large positions over time, while distribution is their strategic selling, offloading those positions. The duration and intensity of this cause directly determine the magnitude and longevity of the subsequent effect, the ensuing upward or downward trend. A prolonged period of accumulation, characterized by significant volume within a trading range, suggests a powerful underlying cause that is likely to lead to a substantial upward move. Similarly, an extended phase of distribution indicates a strong cause for a significant decline. The practical application of this law for profit lies in identifying these critical phases of accumulation and distribution as they unfold on the chart. by recognizing when smart money is actively accumulating assets. Traders can position themselves to ride the wave of the subsequent uptrend, buying low in anticipation of higher prices. Conversely, identifying distribution phases allows traders to either exit their long positions before a decline or initiate short positions, profiting from the anticipated downward movement. These phases are not always immediately obvious and require careful analysis of price and volume within a defined trading range. However, mastering their identification provides a robust framework for understanding the market's underlying intentions and positioning oneself for future price swings. It forms the very foundation for predicting the scale of future trends, offering a strategic advantage. The third crucial law is the law of effort versus result, which highlights the critical relationship between trading volume, representing effort, and price change, representing result. According to this law, changes in the volume of trades, the effort exerted by market participants, should logically correspond with the resulting changes in price. When there is significant effort, high volume, but little corresponding price movement, small range, it suggests that opposing forces are balanced or that the effort is being absorbed. Conversely, if there is a large price movement with disproportionately low volume, it indicates a lack of genuine conviction behind the move, suggesting it might be manipulative or unsustainable. This divergence between effort and result often serves as a powerful harbinger of a potential trend reversal. For maximizing profit, analyzing this law helps traders ascertain the true strength or weakness of an asset. For instance, if an asset's price is rising but the volume is consistently low or declining, it signals a lack of genuine buying interest and could indicate that the upward movement is fragile or a shakeout designed to trap unsuspecting buyers. Such a discrepancy suggests that the effort to push prices higher is not yielding a commensurate result, implying underlying weakness. Conversely, if prices are falling on low volume, it might suggest that selling pressure is diminishing, potentially foreshadowing a reversal to the upside. Recognizing these divergences allows traders to avoid entering positions based on misleading price action or to prepare for an imminent shift in market direction, thereby protecting capital and capitalizing on emerging opportunities. This constant vigilance over the relationship between volume and price is paramount for informed decision-making. These three fundamental laws, supply and demand, cause and effect, and effort versus result, are not isolated concepts but rather interconnected principles that provide a holistic framework for market analysis. They equip traders with the ability to look beyond surface-level price movements and delve into the underlying forces that truly drive the market. By consistently applying these laws, one can develop a deeper understanding of market logic, leading to more confident and ultimately more profitable trading decisions. The mastery of these foundational ideas is an indispensable prerequisite for effectively navigating the complexities of market cycles and successfully implementing Wyckoff's more advanced analytical tools. For those eager to delve deeper into the original insights of this market master, a foundational text offers unparalleled guidance. Richard Wyckoff's own work, How I Trade and Invest in Stocks and Bonds, is an essential resource for anyone serious about understanding the true mechanics of the market. This adapted edition provides a direct link to Wyckoff's time-tested methods, offering a unique opportunity to learn directly from the source. It meticulously details his strategies for analyzing market behavior, deciphering the intentions of major institutional players, and making well-informed trading decisions that stand the test of time. By immersing yourself in this classic, you gain not just theoretical knowledge but practical wisdom distilled from decades of market experience. This book empowers you to develop a sophisticated understanding of market cycles and to identify those critical junctures where smart money prepares for significant moves. It's more than just a book, it's a masterclass in market psychology and strategic positioning, directly from the mind of one of trading's most influential figures. Don't miss the chance to enhance your trading acumen with this timeless classic. Find the link in the description below to secure your copy and begin your journey towards mastering Wyckoff's powerful techniques. Building upon these foundational laws, Wyckoff identified four distinct phases that characterize every market cycle: accumulation, markup or uptrend, distribution, and markdown or downtrend. Understanding these phases is crucial because they represent the structured progression of institutional activity, from strategically acquiring assets to systematically selling them off. Each phase presents unique opportunities and challenges, and recognizing which phase the market is currently in allows traders to align their strategies with the prevailing underlying forces. This cyclical nature of the market, driven by the actions of smart money, provides a predictable framework for anticipating future price action. The first critical phase is accumulation, a period of sideways price movement that typically follows a prolonged downtrend. During this phase, smart money, the well-informed institutional investors, strategically and patiently accumulates large quantities of assets at what they perceive to be favorable, undervalued prices. This process is characterized by a gradual absorption of selling pressure, as supply is steadily bought up without causing a significant upward price movement. The market appears to be consolidating, but beneath the surface, a powerful cause is being built for a future effect, a significant uptrend. Identifying the nuances of this phase is paramount for capturing substantial gains. Within the accumulation phase, several key events unfold, each offering valuable clues for identifying potential entry points. The preliminary support is the initial attempt to halt the prevailing downtrend, often marked by increased buying interest. It signifies that some institutional players are beginning to step in, even if the selling pressure is not yet fully exhausted. Following this, the selling climax occurs, characterized by a period of panic selling on extremely high volumes, pushing prices to new lows. This event typically cleans out the last of the weak holders, providing smart money with ample liquidity to accumulate at discounted prices. The market sentiment is overwhelmingly negative, creating a perfect environment for stealth accumulation. Immediately after the selling climax, an automatic rally often takes place. This is a sharp, impulsive upward movement in price, driven by short covering and the absence of significant selling pressure after the climax. The automatic rally establishes the upper boundary of the developing trading range, defining the initial parameters of the accumulation zone. Subsequently, a secondary test occurs, where the market retests the lows established by the selling climax, usually on significantly lower volume. This test confirms whether the selling pressure has truly subsided and whether demand is now sufficient to absorb any remaining supply. A successful secondary test, where the low holds and volume is low, indicates a strong likelihood that the market is indeed in an accumulation phase. One of the most deceptive yet crucial events in accumulation is the spring. This involves a false breakdown below the established lows of the trading range, designed to shake out any remaining weak hands or trap bearish traders. Prices quickly return back into the trading range after this deceptive move, confirming that the breakdown was a manipulation rather than a genuine continuation of the downtrend. The spring is a critical test of the residual supply. If prices bounce back strongly on increasing volume, it signals that demand has overcome supply and the accumulation is nearing completion. This event often presents an excellent low-risk entry opportunity for astute traders. Following a successful spring, a sign of strength often emerges. This is a strong upward movement in price, usually accompanied by increased volume, that breaks above a resistance level within the trading range. The sign of strength confirms the growing dominance of demand and indicates that smart money is preparing to initiate the markup phase. It acts as a clear signal that the market's underlying bias has shifted from bearish to bullish. Finally, the last point of support provides one of the final and often safest opportunities for entry before the full markup phase begins. This event involves a minor pullback that retests a previously broken resistance level, which now acts as support. It's a last chance for smart money to add to their positions and for observant traders to join the emerging uptrend with relatively low risk. The strategies for maximizing profit during the accumulation phase involve patient observation and precise execution. The most opportune entry points typically occur after a confirmed spring, when the market has demonstrated its ability to recover from a false breakdown, or during the retest of a sign of strength at the last point of support. These entries offer a favorable risk-to-reward ratio, as stop-loss orders can be placed relatively tight, just below the spring low or the last point of support, while the potential for significant upward movement is high. By understanding and anticipating these events, traders can position themselves early in an emerging uptrend, capitalizing on the substantial gains that follow a successful accumulation. This patient approach is crucial to avoid being shaken out by the market's manipulative moves. Conversely, the distribution phase is characterized by a period of sideways price movement that follows a prolonged uptrend, signaling that smart money is strategically selling off their accumulated assets. During this phase, institutional investors gradually liquidate their positions into the buying enthusiasm of less informed traders. The market appears to be consolidating at higher levels, but beneath the surface, a powerful cause is being built for a future effect, a significant downtrend. Recognizing the signs of distribution is crucial for exiting long positions profitably or initiating short positions to benefit from an impending decline. This phase is essentially the inverse of accumulation, with smart money systematically offloading holdings. Similar to accumulation, the distribution phase features a series of key events that provide critical clues for identifying potential exits or short entry points. The preliminary supply marks the first signs of institutional selling, slowing down the upward momentum of the trend. It indicates that smart money is beginning to lighten their positions, even if buying pressure still appears strong. This is followed by a buying climax, an intense period of buying activity on extremely high volumes, often driven by emotional retail traders who are late to the trend. This climax typically marks the exhaustion of buying power and provides smart money with the liquidity needed to offload their largest positions. The market sentiment is overwhelmingly bullish, creating a perfect environment for stealth distribution. Immediately after the buying climax, an automatic reaction typically occurs. This is a sharp, impulsive downward movement in price, driven by the sudden emergence of selling pressure and the absence of strong buying. The automatic reaction establishes the lower boundary of the developing trading range, defining the initial parameters of the distribution zone. Subsequently, a secondary test takes place, where the market retests the highs established by the buying climax, usually on significantly lower volume. This test confirms whether the buying pressure has truly subsided and whether supply is now sufficient to absorb any remaining demand. A successful secondary test, where the high holds and volume is low, indicates a strong likelihood that the market is indeed in a distribution phase. A particularly deceptive and crucial event in distribution is the upthrust. This involves a false breakout above the established highs of the trading range, designed to trap bullish traders into buying at elevated prices. Prices quickly return back into the trading range after this manipulative move, confirming that the breakout was a false signal rather than a genuine continuation of the uptrend. The upthrust serves as a final test of residual demand. If prices quickly fall back on increasing volume, it signals that supply has overcome demand and the distribution is nearing completion. This event often presents an excellent low-risk entry for short positions for astute traders. Sometimes a more pronounced manipulative move occurs, known as the upthrust after distribution. This is a final, often more aggressive, false breakout above the trading range, designed to lure in the last remaining buyers before the market collapses. It is a powerful bearish trap. Following these manipulative moves, a clear sign of weakness often emerges. This is a strong downward movement in price, usually accompanied by increased volume, that breaks below a support level within the trading range. The sign of weakness confirms the growing dominance of supply and indicates that smart money is preparing to initiate the markdown phase. It acts as a clear signal that the market's underlying bias has shifted from bullish to bearish. Finally, the last point of supply provides one of the final and often safest opportunities for short entry before the full markdown phase begins. This event involves a minor rally that retests a previously broken support level, which now acts as resistance. It's a last chance for smart money to complete their selling and for observant traders to join the emerging downtrend with relatively low risk. The strategies for maximizing profit during the distribution phase involve patient observation and precise execution, mirroring the approach in accumulation but in reverse. The most opportune moments for exiting long positions or initiating short positions typically occur after a confirmed upthrust or upthrust after distribution, when the market has demonstrated its inability to sustain higher prices, or during the retest of a sign of weakness at the last point of supply. These entries offer a favorable risk-to-reward ratio for short positions, as stop-loss orders can be placed relatively tight, just above the upthrust high or the last point of supply, while the potential for significant downward movement is high. By understanding and anticipating these events, traders can protect their capital and profit from market declines, effectively turning bearish sentiment into profitable opportunities. This strategic selling is just as important as strategic buying. Wyckoff's 5-step approach to market analysis provides a structured methodology for applying these laws and identifying the market phases, ultimately optimizing profit generation. This systematic framework ensures that traders consider all relevant factors before making a decision, moving beyond mere pattern recognition to a deeper understanding of market logic. Each step builds upon the previous one, guiding the trader through a comprehensive evaluation process that culminates in a high-probability trade setup. This methodical approach minimizes emotional decision-making and maximizes the potential for success by aligning with the actions of smart money. The first step is to determine the current position and the probable future tendency of the market as a whole. This involves analyzing the overall market context, identifying whether the major trend is bullish, bearish, or sideways, and understanding the dominant forces at play. The key question here is whether large institutional players are actively participating in the market and what their likely objectives are. Are they accumulating across the board, or are they distributing? This macro-level analysis provides the essential backdrop against which individual asset movements should be evaluated. Without understanding the broader market tide, it is difficult to accurately interpret the movements of individual stocks or commodities. This step helps in avoiding trades that go against the prevailing market sentiment. The second step involves evaluating the strength of a specific asset relative to the broader market. This comparative analysis is crucial for selecting the most promising candidates for trading. Traders should seek out assets that demonstrate superior strength during market rallies, showing greater percentage gains, and exhibit relative resilience or smaller declines during market pullbacks. Such assets indicate strong underlying demand and are often those being actively accumulated by smart money. Conversely, in a bearish market, one would look for assets showing relative weakness, declining more sharply than the overall market. This relative strength or weakness provides a powerful filter for identifying potential outperformers or underperformers, increasing the probability of a successful trade. The third step focuses on determining the cause that is equal to or exceeds the minimum price objective. This involves using the established trading ranges of accumulation or distribution to project potential price targets. Wyckoff developed specific methods, often involving point and figure charts, to measure the cause built within a trading range and translate it into a quantifiable effect, a projected price movement. By accurately measuring the horizontal extent of an accumulation or distribution phase, traders can estimate the potential vertical movement that is likely to follow. This step provides a tangible target for profit-taking, ensuring that trades are entered with a clear understanding of their potential reward. It helps in setting realistic expectations and avoiding premature exits. The fourth step is to assess the asset's readiness for movement, which means confirming that the accumulation or distribution pattern is complete and poised for a breakout or breakdown. This involves a meticulous analysis of the price and volume action within the trading range, looking for the specific events of accumulation, like a spring and a sign of strength, or distribution, like an upthrust and a sign of weakness. The market needs to show clear signs that the supply-demand balance has definitively shifted in one direction, indicating that smart money has finished their preparatory phase. This step ensures that traders are not entering positions too early, before the market is truly ready to move, reducing the risk of being caught in further consolidation or false moves. It is about timing the entry with precision. The fifth and final step is to select the optimal entry point, which involves analyzing the asset's price behavior in relation to the overall market at the precise moment of entry. This step refines the timing, looking for confirmations such as a breakout on increasing volume, a retest of a key support or resistance level, or a clear shift in momentum. The goal is to enter the trade with the highest probability of success and the lowest possible risk. This often means waiting for a clear signal that the market is indeed beginning its markup or markdown phase, rather than speculating during the quieter periods of accumulation or distribution. By combining the macro market context with asset-specific readiness and precise entry signals, traders can construct robust trading setups. Managing positions and risks effectively is just as crucial as identifying trading opportunities when applying Wyckoff's method for maximum profit. Even the most perfectly timed entry can lead to losses if proper risk management protocols are not in place. Wyckoff emphasized a disciplined approach to capital preservation and strategic position sizing, understanding that consistent profitability comes from managing both winning and losing trades intelligently. This section outlines key considerations for ensuring that the hard-won insights from Wyckoff analysis translate into tangible financial gains, protecting capital while maximizing returns. Determining realistic target prices is a fundamental aspect of profitable trading, and Wyckoff's schemes provide an excellent framework for this. By meticulously analyzing the horizontal extent of the accumulation or distribution trading ranges, traders can project potential price objectives for the subsequent markup or markdown phases. These projections, often calculated using point and figure charting methods, provide concrete goals for profit-taking. Having a clear target helps traders avoid the common pitfall of holding on to winning positions for too long, only to see profits erode, or selling too early and missing out on significant gains. It instills discipline and provides a roadmap for managing the trade from entry to exit, aligning expectations with market potential. Equally important is the strategic placement of stop-loss orders, which are essential tools for minimizing potential losses and protecting capital. When entering a long position in an accumulation phase, stop-loss orders should be placed logically below key support levels within the trading range, such as below the low of a spring or the last point of support. This placement ensures that if the accumulation pattern fails and the market moves against the anticipated direction, losses are contained. Conversely, when initiating a short position in a distribution phase, stop-loss orders should be positioned above critical resistance levels, such as above the high of an upthrust or the last point of supply. Proper stop-loss placement is a non-negotiable aspect of risk management, preventing small losses from escalating into catastrophic ones. The continuous monitoring of trading volumes remains paramount throughout the life of a trade. Volumes serve as a vital confirmation of trend strength or a warning sign of its potential weakening. In a markup phase, consistently high or increasing volume accompanying price advances confirms robust demand and the health of the uptrend. Conversely, if prices continue to rise but volume begins to diminish, it suggests a lack of conviction from buyers and could signal an impending exhaustion of the trend, indicating that smart money is no longer actively supporting the move. Similarly, in a markdown phase, increasing volume on price declines confirms strong selling pressure. A decline in volume during a downtrend might suggest selling exhaustion. Any significant price movement without commensurate volume should be viewed with suspicion, as it may indicate a manipulative move or a lack of genuine market participation. Finally, the adaptability of the Wyckoff method to various time frames offers immense flexibility for traders of different styles and preferences. Whether one is a long-term investor analyzing weekly charts or a short-term swing trader focusing on hourly or daily charts, Wyckoff's principles remain equally applicable and effective. The fundamental laws of supply and demand, cause and effect, and effort versus result, along with the four market phases and their associated events, operate across all time horizons. This scalability allows traders to apply the method to diverse instruments and trading strategies, from equities and commodities to cryptocurrencies and forex. The core logic of smart money actions remains consistent, regardless of the charting period, making Wyckoff a versatile and powerful analytical tool for any market participant. In conclusion, the method of Richard Wyckoff provides an unparalleled and powerful framework for understanding the intricate dynamics of the market and making highly informed trading decisions. His foundational laws, supply and demand, cause and effect, and effort versus result, offer a profound lens through which to interpret price and volume action, revealing the hidden intentions of institutional players. By dissecting the four distinct market phases of accumulation, markup, distribution, and markdown, along with their associated key events, traders gain the ability to anticipate significant price movements and position themselves strategically for maximum profit. The systematic five-step approach further refines this analysis, guiding market participants through a comprehensive evaluation process from market context to precise entry points. Despite being developed over a century ago, the enduring efficacy of Wyckoff's method is a testament to its timeless principles. The fundamental laws, market cycles, and phases that govern financial markets remain remarkably consistent, largely because they are rooted in human psychology and the unchanging behavior of large institutional capital. What was true for the markets of Wyckoff's era largely holds true today, making his insights as relevant and powerful as ever in the modern trading landscape. This longevity underscores the robustness and universal applicability of his analytical framework, proving that understanding underlying market mechanics transcends technological advancements or specific market conditions. We strongly encourage all traders, from beginners to seasoned professionals, to embark on a deeper exploration and diligent practice of applying Wyckoff's laws. The potential for achieving maximum profit while minimizing risk is significantly enhanced through a thorough understanding and skillful implementation of his methodology. It offers a structured, logical pathway to navigating market complexities with greater confidence and precision. The journey to mastery requires dedication, observation, and continuous learning, but the rewards of consistently identifying high-probability trading opportunities are substantial. Remember, successful application of the Wyckoff method demands more than just theoretical knowledge. It necessitates persistent practice and keen observation of live market data. The ability to recognize the subtle nuances of price and volume action, to differentiate between genuine market shifts and manipulative traps, is honed through experience. Therefore, commit to daily chart analysis, backtest historical data, and gradually integrate these powerful principles into your trading strategy. The effort invested in mastering Wyckoff's approach will undoubtedly yield significant dividends, transforming your understanding of the market and elevating your trading performance to new heights. For those looking to expand their trading knowledge even further, we highly recommend exploring other valuable resources. Our channel, Trading Insights, delves into the strategies, methods, and core principles employed by specific successful traders, speculators, and investors throughout history and in contemporary markets. You'll gain a unique perspective on how top performers approach market challenges and capitalize on opportunities. Additionally, immerse yourself in the rich tapestry of financial history with Wall Street Memoirs. This channel offers captivating narratives about historical market events, pivotal financial crises, and the remarkable figures who shaped the landscape of Wall Street. Understanding the past can provide invaluable context for navigating the present and future markets. Both channels offer distinct yet complementary learning experiences that will deepen your market acumen. Be sure to subscribe to Trading Insights and Wall Street Memoirs to continue your journey of financial education and discovery. The links to both channels are conveniently located in the description below.